Every American history textbook tells the same story. On October 29, 1929, the New York Stock Exchange collapsed. Panicked traders dumped shares. Fortunes vanished in an afternoon. And from that single Black Tuesday, the story goes, the entire American economy spiraled into the worst depression in modern history. And that part is true. The crash happened. $30 billion in market value, roughly $14 billion in the fall of October 29th alone, was wiped out. People did lose everything. Some did jump from windows, though that particular image is more myth than statistic, as we will get to. But here is the problem. That explanation is dangerously incomplete. A stock market crash, on its own, has never been enough to cause a decade-long global depression. The 1987 crash was proportionally just as brutal. The economy barely noticed. So what turned a bad October on Wall Street into 25% unemployment, 4,000 bank failures, and a global collapse that helped elect Adolf Hitler? The answer is not on Wall Street. It is in a marble building on Liberty Street in Manhattan, in the sudden death of one man nobody has heard of, in a tariff bill 3,000 economists begged a president not to sign, and in the quiet, catastrophic decision to do nothing while the money supply of the United States collapsed by a third. So let us go back to 1928. To understand 1929, you have to understand a man named Benjamin Strong. Strong was not the president. He was not even the official head of the Federal Reserve System. On paper, that title belonged to the Federal Reserve Board in Washington. But from 1914 to 1928, Strong ran the Federal Reserve Bank of New York, and the New York Fed was, in practice, the most powerful economic institution on earth. Here is why that mattered. The Federal Reserve System, created in 1913, was structurally decentralized on purpose. Congress had split power across 12 regional banks, specifically so no single man could dominate American monetary policy. It did not work. Strong built personal relationships with the central bankers of Britain, France, and Germany. Montague Norman of the Bank of England was practically a second self. Together, through the 1920s, these men coordinated interest rates across 4 countries, almost entirely outside any democratic process, trying to keep the post-World War I gold standard from tearing itself apart. Nobody elected them to do this. In 1927, at a secret meeting at the estate of financier Ogden Mills, Strong agreed to lower American interest rates specifically to help Britain defend the pound sterling. Adolf Miller, a member of the Federal Reserve Board in Washington, later called it the greatest and boldest operation ever undertaken by the Federal Reserve System, and said it led directly to the crash. Cheap credit flowed. Margin lending, buying stocks with borrowed money, exploded. By 1929, an estimated 40% of new bank lending nationally was flowing into stock market speculation rather than industry or agriculture. Farm income, meanwhile, had never recovered from a post-World War I agricultural depression that most Americans have simply forgotten existed. The boom looked universal. It was not. Then, on October 16, 1928, Benjamin Strong died of tuberculosis-related complications at age 55. This is the detail almost no textbook mentions, and it is the hinge point of the entire crisis. Strong's successor, George Harrison, was a capable lawyer, but nowhere near as forceful, nowhere near as internationally connected, and nowhere near as willing to override the Federal Reserve Board in Washington when it mattered. For a decentralized system that had, in practice, been running on one man's judgment for 14 years, this was a leadership vacuum at the worst possible moment. Milton Friedman and Anna Schwartz, in their landmark 1963 study, A Monetary History of the United States, argue this is the single most consequential death in American economic history. Had Strong lived, they wrote, the Federal Reserve would almost certainly have moved aggressively to inject liquidity when the banking system began to fail in 1930 and 1931, the way Strong had personally forced the Fed to act during a smaller banking panic in 1924. Instead, the Federal Reserve Board, freed from Strong's dominance, spent the next 4 years arguing. So here is the mechanism history books skip past. Between 1929 and 1933, the American money supply, cash, checking deposits, the actual fuel of the economy, contracted by roughly a third. Not shrank a little, a third. When money disappears from an economy at that scale, prices fall. When prices fall, businesses cannot pay debts contracted at higher price levels. Businesses fail. Banks that lent to those businesses fail. Depositors, terrified, pull cash from every other bank, which forces those banks to call in loans and sell assets at fire sale prices, which destroys more money, which pushes prices down further. Economists call this a debt deflation spiral. Irving Fisher, the most prominent American economist of the era, described it in a 1933 paper the same year he lost most of his personal fortune to it. The Federal Reserve had the tools to stop this. Under the Federal Reserve Act, the system could buy government securities on the open market, injecting cash directly into the banking system exactly when banks needed it most. It largely did not. Why not? This is where the historiographical debate really starts. But the short version, the Federal Reserve Board in Washington was dominated through these years by officials who believed in what is called the liquidationist view, the idea, associated with Treasury Secretary Andrew Mellon, that the Depression was a necessary purging of excess speculation, and that the government's job was to let weak banks and businesses fail so the economy could rebuild on solid ground. Mellon reportedly told Hoover to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. Hoover, in his own memoirs published decades later, quoted Mellon saying almost exactly that, though Hoover framed it as advice he rejected. Was this negligence, ideology, or genuine economic conviction? Historians still argue. But the money supply contracted, and the Fed, holding tools that could have stopped it, largely stood aside. By late 1930, three distinct forces were now compounding each other. A stock crash that had destroyed paper wealth and confidence, a Federal Reserve that had failed to backstop a collapsing banking system, and a trade war that Congress was actively making worse in real time. This is where historians split. Was the Depression fundamentally a monetary catastrophe, a failure of the Federal Reserve, or was it a broader structural collapse that no central bank could have fully prevented? Let us hear both sides. The monetarist case comes primarily from Milton Friedman and Anna Schwartz. In A Monetary History of the United States, they argue the Great Depression should really be called the Great Contraction, because the defining event was not the crash. It was the Federal Reserve allowing roughly a third of the money supply to vanish between 1929 and 1933. Friedman and Schwartz point to specific Federal Reserve Open Market Committee minutes from 1930 and 1931, showing officials actively debating and then rejecting large-scale bond purchases that would have injected liquidity, decisions Friedman called, in later interviews, the worst failure of American central banking in its history. Their thesis was influential enough that Federal Reserve Chairman Ben Bernanke, at Friedman's 90th birthday celebration in 2002, told him directly, "You're right, we did it, we're very sorry, but thanks to you, we won't do it again," referring to the Fed's aggressive 2008 crisis response. If one institution's inaction can be blamed for turning a recession into a depression, what does that say about how much power we've concentrated in unelected central bankers? I am not here to say the monetary contraction did not matter, it did. But here is what a purely Fed-centered narrative leaves out. Barry Eichengreen, in his 1992 book, Golden Fetters, The Gold Standard and the Great Depression, 1919 to 1939, argues the deeper cause was the international gold standard itself. Every major country had tied its currency to gold after World War I, which meant every central bank, including the Federal Reserve, was constrained in how much money it could create. Expand the money supply too far, and gold would flow out of the country, threatening the currency's convertibility. Under this view, the Fed was not simply negligent. It was structurally trapped by a monetary system that made an aggressive rescue politically and legally difficult. Peter Temin, an economic historian at MIT, made a related argument in his 1976 book, Did Monetary Forces Cause the Great Depression? Temin's answer, notably, was largely no. He pointed to falling consumption and investment in 1930 that predates the worst of the monetary contraction, suggesting the initial downturn had non-monetary roots that the Fed's later failures then made catastrophically worse. So which is it? A Federal Reserve that failed, or a global monetary system so rigid that failure was almost built in? The honest answer, and where most economic historians land today, is both. The gold standard removed the Fed's room to maneuver. The men running the Fed, freed of Benjamin Strong's judgment, chose not to use what room remained. Structure loaded the gun. Choices pulled the trigger. Let me bring these threads together with one more piece, because the gold standard argument explains something the pure monetarist story does not: why the Depression went global almost immediately. Because every major economy was tied to gold, a monetary contraction in the United States forced contractions elsewhere. Countries that abandoned gold early, Britain in September 1931 for instance, recovered faster than countries that clung to it. Countries that stayed on gold longest, including France and, fatefully, Germany, suffered longer and deeper depressions. Germany's unemployment rate hit roughly 30% by 1932, an economic catastrophe historians, including Ian Kershaw, in his biography Hitler, 1889–1936 Hubris, identify as a direct precondition for the Nazi Party's electoral breakthrough that same year. This is where it gets strange. An American central banking decision filtered through an international gold standard helped produce the political conditions for the rise of Hitler. That is not conspiracy. That is monetary economics with genuinely global consequences. Back in Washington, the internal Fed conflict Friedman and Schwartz described was not abstract. It was between actual people. The Federal Reserve Board, then chaired by Roy Young and later Eugene Meyer, repeatedly resisted proposals from George Harrison's New York Fed to conduct large open market bond purchases in 1930 and 1931. The board's own internal reasoning, preserved in Federal Reserve Committee records now housed at the National Archives, cited concerns about speculative excess returning and about protecting gold reserves. Harrison pushed for action. He was outvoted repeatedly by representatives of the other regional banks who worried aggressive easing would simply refuel speculation. By the time the board reluctantly authorized larger purchases in 1932, under pressure from Congress, including a resolution sponsored by Senator Carter Glass, co-author of the original 1913 Federal Reserve Act, much of the damage was irreversible. Banks had already failed. Depositors had already lost confidence. Let us make this concrete with one institution, because a statistic like 4,000 bank failures does not mean anything until you understand what a bank failure actually did to a real town. When a local bank failed in, say, rural Nebraska in 1931, it did not just close a building. Farmers who had deposited a harvest's worth of cash lost it entirely. Federal deposit insurance did not exist yet. The FDIC was not created until 1933. Local businesses that depended on that bank for loans to buy seed or inventory for the next season had no credit source. The town's entire monetary circulation, in some cases, simply stopped. Multiply that by roughly 9,000 bank failures across the 1930s, and you start to see how a monetary contraction becomes a human catastrophe, not just a line on a chart. So who, specifically, gets the blame here? Not vague forces. Specific people, specific decisions, specific dollar amounts. Let us spread it out properly. First, the Federal Reserve Board members who repeatedly rejected New York's push for aggressive open market operations between 1929 and 1931, a group Friedman and Schwartz named specifically, including Governor Roy Young and later Eugene Meyer's board. Their decisions, documented in Federal Open Market Investment Committee minutes, allowed the money supply to contract by an estimated 31% between 1929 and 1933, according to Friedman and Schwartz's own calculations. Second, Senator Reed Smoot of Utah and Representative Willis Hawley of Oregon, authors of the Smoot-Hawley Tariff Act, signed into law by Herbert Hoover on June 17, 1930. The act raised tariffs on over 20,000 imported goods to some of the highest rates in American history. More than 1,000 economists in a petition organized by economists at Columbia, Cornell, and other universities and printed in the New York Times in May 1930 begged Hoover not to sign it, warning explicitly of foreign retaliation. Hoover signed it anyway. Retaliation came fast. Canada, America's largest trading partner, and European nations including France and Britain raised their own tariffs in response. Global trade, already weak, collapsed further. Global trade volume fell by roughly 66% between 1929 and 1934, according to League of Nations trade data compiled by economic historian Charles Kindleberger in his 1973 book, The World in Depression, 1929 to 1939. What kind of president signs a bill more than 1,000 of the country's own economists warned him against? Third, and this surprises people, Herbert Hoover himself. Not the caricature of a do-nothing president, which is itself a historical myth worth correcting. Hoover actually increased federal spending, created the Reconstruction Finance Corporation in 1932 to lend to banks and railroads, and pushed public works spending higher than any peacetime president before him. But Hoover also, in 1932, signed the Revenue Act, which raised the top marginal income tax rate from 25% to 63%, and raised a wide range of other taxes in a mistaken effort to balance the federal budget during a collapsing economy. Most economic historians today, including Eichengreen, consider this one of the most damaging fiscal policy errors of the entire crisis, tightening precisely when the economy needed the opposite. Fourth, December 11, 1930. The Bank of the United States, a private commercial bank headquartered in New York with no actual government affiliation, despite its official-sounding name, collapsed. It was, at the time, the largest bank failure in American history, wiping out roughly 400,000 depositors, many of them working-class immigrant families in the Bronx and Manhattan who had trusted the name. Friedman and Schwartz argued this specific failure mattered enormously because the name confused ordinary Americans and foreign observers alike into thinking a government-backed institution had failed, accelerating a nationwide crisis of confidence in the banking system as a whole, even though it was, legally, just one overextended private bank that other New York banks had discussed rescuing and ultimately declined to. So here is the thesis, plainly. The stock market crash of October 1929 was real, and it mattered. But what history books get wrong is treating it as the cause of the Great Depression rather than the trigger for it. The actual cause was a Federal Reserve that, freed from Benjamin Strong's dominant judgment by his sudden death, allowed the American money supply to collapse by roughly a third. A collapse worsened by a self-inflicted trade war, a mistaken tax increase, and a gold standard that trapped every major economy in the same downward spiral together. What history books get wrong is the assumption that depressions simply happen. This one was, in large part, chosen through inaction as much as action, by specific named officials making specific votes in specific rooms. By 1933, unemployment in the United States reached roughly 25%. Industrial production had fallen by nearly half from its 1929 peak. Roughly 9,000 banks failed over the course of the decade, taking the life savings of millions of families who had no deposit insurance to protect them. Farm income fell by more than half. In parts of the rural Midwest and South, the collapse compounded with the ecological disaster of the Dust Bowl, driving hundreds of thousands of families from their land entirely. Behind every one of those percentages was a specific family deciding whether to eat that week. In cities, Hoovervilles, shantytowns built from scrap wood and tar paper, named bitterly after the president, sprang up in nearly every major American city, from Central Park to the banks of the Anacostia River in Washington, D.C. Bread lines stretched for blocks. Suicide rates, contrary to popular myth, did not actually spike dramatically in the days immediately after the crash. That is a legend, not a documented statistic. But they did rise steadily over the early 1930s as the human toll of prolonged unemployment and bank failures deepened. If your grandparents or great-grandparents lived through this era, there is a real chance that a story you have heard in your own family about a lost farm, a vanished bank account, a relative who rode the rails looking for work, traces back to a decision made in a Federal Reserve boardroom you have probably never heard of. Recovery, when it finally came, validates the monetary thesis in an almost uncomfortable way. Franklin Roosevelt took the United States off the domestic gold standard in 1933 and devalued the dollar. The money supply, freed from the gold constraint, began expanding again. Industrial production started recovering almost immediately in 1933 and 1934. It was not a coincidence historians dismiss lightly. Christina Romer, in a widely cited 1992 paper, What Ended the Great Depression, found that roughly half of the recovery between 1933 and 1937 can be attributed directly to monetary expansion following the departure from gold, not to New Deal fiscal spending, which, while significant, was smaller in scale than often assumed. The Depression, in other words, ended largely the same way it began, through monetary policy. This time, the policy moved in the right direction. Here is why this history is not just history. In March 2020, facing a pandemic-driven economic collapse, the Federal Reserve, under Chairman Jerome Powell, moved within days to slash interest rates to near zero and purchase trillions of dollars in government securities and other assets. Precisely the kind of aggressive open market intervention that the 1931 Federal Reserve Board had refused to authorize, and refused for years. Powell has cited the Depression-era failures directly in public remarks, justifying the speed of the 2020 response. The 2008 financial crisis response, led partly by Ben Bernanke, an academic historian of the Great Depression himself before joining the Fed, followed the identical logic. Flood the system with liquidity fast. Don't repeat 1930. If today's central bankers explicitly built their entire modern playbook around not repeating the specific set of decisions made by a handful of men in 1930 and 1931, doesn't that tell you almost everything about how much this history still matters? So the next time you hear the Great Depression described as simply, the stock market crashed and everyone panicked, you will know the fuller story. A death, a tariff, a tax increase, and a monetary contraction that a functioning central bank had the tools to stop and did not. The stock market crash of 1929 was the spark. The real fire was a Federal Reserve that let a third of America's money supply disappear, a trade war Congress chose to start, and a gold standard that left the whole world trapped in the same collapse together. That same lesson, that central banks must flood the system with liquidity fast rather than wait, is the direct reason today's Federal Reserve moved within days, not years, during both 2008 and 2020. If you found this useful, subscribe. We release new financial history every week. Drop a comment below which part surprised you most. I read every single one. I'll see you in the next one.